I'm going to just go ahead and be bold and say good afternoon, everyone, now that we're with the time change. We're so happy you're on the call today. Thank you so much for being here. We're going to have Brad Shepard from OneAmerica go over asset-based long-term care. He's been an amazing partner, and we're always willing to help. Their team has been amazing. So without further ado, I'm going to have him start, but I will say a little housekeeping. If you do have any questions during the presentation, please write them into the question box, and I will make sure to get to them at the end. Brad, you want to take it over?
Absolutely. Thank you so much, and I appreciate this opportunity to speak with you live today around, long-term care, the very fun subject of long-term care. Now, I know you're on mute, so I can't hear all those chuckles in the background, but it is very important, obviously, for not only you, but also for your clients in preparing for what they face even throughout their retirement years. So I don't have an agenda slide, but I'll just go through verbally what we want to accomplish here today. The first part, and this is, I think, the most important part, because, products will change, benefits, design, pricing, all of that will change over time. But the one thing that will not change is the human factor and how to have this conversation with clients in being able to broach this in a way that you can move forward the conversation to have your clients consider putting a plan in place for potentially needing this type of care. So we'll go through that. We'll go through, the difference between the emotional and the logical approach and how to mix two together depending on who you're speaking with. We'll give you a couple of just baseline questions that are good conversation starters or ways to get that, initiated with the client. And then we'll transition into the solutions, meaning how to fund some of these different options that are available with insurance products at OneAmerica. I'll take you through that by showing you real life case studies. So it'll go through Mr. and Mrs. Jones at certain ages and certain funding options and show you what those benefits would be, or maybe some things that you want to consider and how to fund that. We'll finish up with a brief review of underwriting and then tackle those questions that Allie just spoke of. So here we go. If I can get my screen to move, just take me a second. Here we go. Sorry about that. So let's just be very blunt, as Allie says, and right to the point. There's really two different ways, and I can probably imagine, you can guess easily the difference between men and women, which person falls more on the emotional side versus the logical side. And that's not a negative. That's just stating it's actually in our DNA. It's how we think. In essence, it's how we think through any type of either crisis that we face or decision that we have to make in life. And so the emotional approach for long-term care planning, most of those decisions are based on some of the family experience or the quote unquote, the event that happened, mom or dad, aunt or uncle or loved one needed care. And what that then focuses on even more is that one word, consequence. So it's more about what are the consequences to those that they love most. And so when people make decisions, and most of the time that's going to be on the female side, it's based on the people that are around me, my family. Then when we look at the logical side, now we know the logical side is really, based on decisions that are backed up with so-called financial common sense, right? Does it make sense for me to put out this much premium for an insurance solution for how much benefit am I getting in return? And most of the time that's backed up with that kind of risk reward, and we call that risk-based approach. And I personally, as a long-term care specialist, don't necessarily agree with this approach, but unfortunately our industry, in a lot of the different communications that are sent out, whether it's articles in magazines or, even down to materials that the insurance carriers build and have for your use, they state things like 70% of people over the age of 65 will need some sort of care. So emotional versus logical, which one's better? There's no right or wrong answer there. I think what we have to do, though, is we have to be able to read our clients and also talk to them about what matters most to them. So let me tell you my story. Now, this webinar today is not about me, Brad Shepard at OneAmerica, but I can tell you the reason why I'm in this industry and the reason why I've been doing this for 21 years, and there's a very good chance that I'll be doing it for the next 21 years and until I hopefully retire one day. But that's because it is very important to me and my family. Now, I grew up on a large farm in northern Pennsylvania, and it was a single wide trailer that I grew up on. We didn't have money. We were land rich and cash poor. Now, don't feel sorry for me. That's not the point. But I didn't know what having the best things in life were, but I thought I had the biggest playground on earth. Now, that's just my childhood. I was never denied a meal. I had many opportunities for sports and being a part of things. But fast forward the clock. Now, when I left home and went off to college, I would come home on the weekends. And on the weekends, I would come home, of course, to visit with now you think I'm going to say family, right? No, I actually wanted to see my hometown girlfriend. And yay, I was in my late teens, right? So I wanted to come home and see my girlfriend, of course, stop by and see my family and get my laundry done. But what I noticed when I wasn't there is that it was my grandparents' farm. We lived across the dirt road from them. I noticed changes because I wasn't there every day. And I'm sure some of you can relate to this. And those changes, as you can imagine, were the beginning of them needing care. It was that beginning, that supervision beginning. Now, to complete the story, we lost about half of that 465-acre farm because of my grandparents needing care. Please don't feel sorry for me or my family, but here's the end of the story that I haven't told you. It wasn't about losing half the farm. My father was the only one of 6 children that stayed on the farm. So my aunts and uncles, my other 5 aunts and uncles, they had their own lives somewhere else off the farm. And if I had you in the room to be able to see you, look you in the eye, I'd ask you this question, and probably the answer that I would get is not very often, but when do you think they would come home to be there to provide care or to pick up the slack? It just didn't happen very often. It happened once in a while over the holidays, but it was based on their life, not based on what was best for the family. I don't fault them for that, but to this day, my father does not have a meaningful relationship with 2 of his brothers and sisters because of long-term care. So the statement I'll make, which is pretty bold, but it's true, long-term care, especially when family members are involved, long-term care never dies. It lives on for generations upon generations upon generations. And so when we look at the next slide, I talked about my story to you, and many of you are strangers to me, right? I'm just a wholesaler from a long-term care insurance company. But that's the part that you want to incorporate into your conversations with your clients or prospects to connect with them, and also then turn the tables to say, how do you want that to look from your perspective within your family infrastructure? So when we paint the picture on the screen, you can see that when there's no true plan in place for long-term care, by default, families will provide it. It's just natural. They will provide the care in most cases. And those responsibilities are not shared equally, just like my story. And then that starts to cause behind the scenes tension and resentment among those family members. And in this case, it was the siblings with my father and his brothers and sisters. And then that can impact their careers, and other parts of the family are disrupted. Definitely happened in our case. And then the final part is it tears families apart. And some of you that have gone through this or are going through this right now are probably, nodding your head saying that is so true. So that is where you want to be able to relate to clients and prospects around this subject matter. Because in the end, The insurance products that may or may not be put in place to help with that plan are irrelevant. The key is to have the conversation and to have a plan in place. So let's now give you a couple of questions on how you can open up this conversation. And these are very basic, very straightforward. But the first one is, Mr. and Mrs. Jones, hey, you may never need care, but if you did, how would that affect your family? And I've already laid that out talking about my family, but that can include spouses, if there is a spouse or partner, children, other family dynamics that are there, and certainly unnecessary losses. And that could be anything under the sun, even down to what I mentioned, like losing the farm. So that's the first question. The second question is, and if you did need care, how would you pay for it? That could be, the government, which I call those the M&Ms, right? Medicare or Medicaid. And then you have insurance policies. Now, traditional long-term care insurance has been around for a long, long time. What we're finding, though, is that clients are gravitating away from that and more towards these types of solutions that I'll get into in just a minute or two. And then, by default, everyone else falls into this self-funding bucket, right? Now, if you notice, the two questions that I've posed to you around how to broach this conversation were not closed-end questions, meaning yes or no, like you were being deposed or on trial. They're open-ended questions, right? Which is trying to get your prospect or your client to talk about this. So let me sum this up and kind of close this portion up with one thought. Now, if tomorrow OneAmerica said, hey, Brad, thanks for your service, but no thanks, we no longer need it. In other words, we don't need you as a wholesaler any longer. And I went out and I hung my shingle as a long-term care specialist talking to clients across the kitchen table again. I promise you I would say this phrase in some way, shape, or form. And that is, after we talked about, putting a plan together or how would you want this to look like for you, I would make a simple statement. Think of this scenario of planning almost like a blank, canvas, an artist that is looking to paint something. It's like a blank canvas. And that blank canvas is the long-term care plan. Now, that plan is not written by me as your financial advisor, right? That's written by you. So all I can provide for you today are the tools like the paint, the brushes, maybe some imagination or thoughts around what you want to have on your canvas. So the question is, do you want someone else to paint your long-term care portrait, or do you want to paint your own and put that plan in place? And that is really the jump start of now let's look at how we can put a plan in place. And that plan, as I mentioned a minute ago, really the wrapper on the plan is a possible insurance contract that can help pay for some or all of that. So now, looking into what long-term care is more just from a planning perspective, it's very, very simple. It's just another retirement expense that can cause your income needs to increase. That's it, right? Because when most people retire, you, as their advisor, or if you're not and they're working with a financial advisor, you help them set a certain standard of living and therefore a certain amount of income that they need in retirement years. Well, just because someone needs health care like this, extended health care, long-term care, that doesn't mean that they should dive into principal to pay for it. It means, where am I going to get the next monthly check to pay for care? So long-term care is actually an income problem. And I'll highlight it on the screen right now. Long-term care is an income problem. It is not just an asset problem. Now, we know that assets generate income, right? So by default, we're going to protect the assets if we have a means to providing income for an intended purpose. And in this case, the intended purpose that we insert here is nothing more than long-term care. So I hope I've broken this down and simplified it for you. I can tell you from years of experience and hundreds of clients that I helped before becoming a carrier rep wholesaler 16 years ago, that is the way that we approached it. And that is exactly the way that I would approach it tomorrow if I went back out and spoke to clients. So now let's transition from setting up the conversation into the funding options and a little bit about OneAmerica here as an insurance company. So what you're seeing on the screen, this is our building in downtown Indianapolis. We are a mutual insurance company, and that matters. We say mutual matters, especially when it relates to long-term care products, because you need to be able to weather some of the financial storms that, well, anyone has to go through over a 20, 30, or 40-year financial cycle. And the reason why we can do that is because we're not beholden to quarterly earnings or stockholders. All decisions are made based on the true owners of the company, which are the policy holders. And we're also very proud of our financial strength. We're top shelf with the rating agencies. Comdex score is 95. You know, there shouldn't be too many financial questions that I would ask around OneAmerica when it comes to their stability. And then our innovation. We really pioneered or started this industry of what we're going to refer to as asset-based long-term care solutions back in the late 80s. So all of the things that I'm going to talk to you about over the next few minutes are time-tested, actuarial tested, claims tested for policyholders that are actually using the contracts. And we have some unique features, which I'll start to go into in here in just a moment. But that's a brief overview of OneAmerica as an insurance carrier. So for those of you that are looking at the screen, and maybe you're not driving or just listening, if you know how to take a screenshot, I'm going to recommend that you take a screenshot right here. Now, we will provide a copy of these slides, no problem, but this is the slide I tell everyone to take a picture of or get a copy of because it tells the entire story of these products at OneAmerica. So what you're going to see is that when we say asset-based LTC, what we really are, what I should say in parentheses is this: we're going to use your money first, the client's money first, almost like a deductible, before we get into the true insurance part of the contract. And so here's what I mean by that. The clients would fund what we call a base policy. And that base policy is either on a life insurance chassis, we call that Asset Care as the name of the product, or an annuity chassis. We're very original here at OneAmerica. We call that annuity care. And beyond that, though, what you should focus your attention on the screen now is these are all the ways that a client could fund that policy. Now, whether that is a single premium in a cash type approach, or whether that is a recurring premium. Now, recurring premium could mean for the rest of their life up to age 95. We call that a pay to 95, or they could do a limited pay. And we have limited pays of 5 pay, 10 pay, or 20 pay. Now, all the products that I'm going to be talking about, I'm going to focus mostly on our core states, meaning there's one state that we have some slight variations, and that is the state of California. So if anyone that is attending today is in the state of California and you want to learn more about that specific product suite that we have remaining, I'm happy to push along some additional materials. What you will find, though, in very short order, coming up hopefully in 2020, California will be on this new version of these products that I'm going to talk about. So the funding options keep going, though, well past single premium with cash, recurring premium. We also can use single premium using qualified money, so that 401k, 403b, existing IRA. Then we can use non-qualified annuities via 1035 exchange or that cash value in an old life policy. See quite a few of those via 1035 exchange. And finally, be creative and think of turning on some of those income riders on a deferred annuity, or even having something annuitized or starting out with a single premium immediate annuity. There's a lot of ways to fund one of these contracts. Now, back to what I stated to start this slide. We are going to use the client's money first for the purpose of long-term care. So we are simply going to accelerate their money first on the base policy. And if they were to exhaust all of this money on the left-hand side, when they buy the contract, they have the option to buy what's called a continuation of benefits rider, or COB rider. You'll hear me say that acronym a lot. Continuation of benefits rider. That rider is not free, and it has one purpose and one purpose only: long-term care. You can only access those benefits for long-term care. Now, one of the unique things that we have at OneAmerica is we have the ability to turn that into up to unlimited or lifetime benefits for long-term care on the rider. Or we can have a limited pool, and I'll show you some of those examples. I told you it's not free, so we could pay for that rider in a single premium, recurring premium, and so forth. And the final part, for those of you that in any way, shape, or form try to help your clients with tax efficiency or potential deductions, keep in mind that the premiums paying for this rider I keep talking about may be deductible to the client. Now, we could do a whole separate training on just that. I will give you one quick sales idea, though. For any clients that have the ability to fund an HSA, please tell them to do so if they're considering something like this. And if they are funding an HSA, tell them to max fund the HSA if they're not currently doing so. The reason being is you can use those HSA dollars to pay for all or some of this rider. And we all know that those HSAs are funded pre-tax. And if you don't use those dollars in the health savings account, they can carry forward into future years. They are not like an FSA where you cannot do that. So let's continue moving forward here. That is the baseline for our products. Now let's turn the table around and say, okay, if I'm a client, how am I viewing these types of policies? These are the advantages that clients are saying are the reasons why they're purchasing them. So the first one is they want a benefit no matter what happens. And we like to use, we throw around these words: live, quit, or die. Live just means that we can accelerate the benefits on the contract. Of course, die means there is an inherent death benefit in any of these types of solutions. And the quit feature is because it does have cash value. And so there is cash value in any of the types of contracts that I'll talk about. Next, the G word. I would say, loosely, to use this phrase, a lot of clients, this is almost like the dot on the exclamation point, right? It is one of the reasons why they feel comfortable putting their head on the pillow at night when they purchase one of these, because of guarantees. So that comes in the form of guaranteed premiums, guaranteed death benefit, the cash value I mentioned, and of course the ability to surrender that cash value. Now on the right-hand side, number 3 and number 4, those are unique to OneAmerica and our products. So the first one is we have joint coverage available. So we can put 2 people on one policy. That is simply a second to die policy structure. I'll show you how that works in just a moment. And number 4, last but not least, is that lifetime or unlimited benefit that I mentioned on the prior slide. What I want to do, though, before moving on, is make sure that we relate this back to something I mentioned earlier. So if we think about long-term care planning as an income issue, not an asset protection issue alone, think about the need for income when people retire. Now, I'm going to be a bit tongue-in-cheek for just a moment, but I want to try to put this in terms of if you are managing a client's money, or even if you don't manage it, but yet you understand, wealth management or people, what they need when they go to retire. Think if I'm your financial advisor and you're going to retire in the next 30, 60 days, and we have that very important pre-retirement meeting. And I walk in the room, hello, Mr. and Mrs. Jones, nice to see you again. Done a lot of work here on your portfolio. Congratulations, you're going to retire in the next month or 2. What I've done is I've put together a plan for income in retirement. And you know what? I've nailed it. this is absolutely perfect. What we've designed here is that your income, to keep you at your standard of living, is going to last to age 82. I mean, it is absolutely perfect. It'll last to age 82. Now, I know you're on mute, and some of you may be saying, what is going on with this guy? Well, you'd be right, because that client, the first thing they're going to do is probably want to throw me out the second, floor window. But the second one is they're going to fire me on the spot and say, no, that's not what we signed up for. We signed up for my income to last how long? Forever. Because I'm going to be the next centenarian. I'm going to live to be 100. I'm going to live forever. So no, I don't want my income to stop at age 82. Now, why do I bring up that tongue-in-cheek scenario? Because it's amazing to me the number of times that when talking about long-term care and the need for care, that people are all of a sudden okay with protecting against the averages. And we've all read in publications that the average length of care that someone needs it is approximately 3 years. I know men are a little bit less and women are a little bit more, but let's just throw out 3 years. You can't have your cake and eat it too, right? You can't say you want your income to last forever, but yet not take care of one of the biggest potential financial consequences to a portfolio in retirement, and that is long-term care. So if we summarize that with the option of providing unlimited or lifetime benefits for long-term care, now you've taken that catastrophic type risk, the Alzheimer's 8, 10, 15 years, that definitely happens a lot. You've taken that catastrophic type risk off the table. And that's what we can provide here at OneAmerica with those lifetime benefits. So let's move on. Here are some case studies. And I'm going to start slow. And once you get the hang of how we're building these things, we'll go faster. So we're going to start with how this industry was built. And the industry was built, back in the 80s and 90s and early 2000s on this premise of single premium, and I would like to even call it single premium packaged. And what does that mean? So we've got a single premium here. Now we've got a couple, joint policy, age 61 and 60. And I'm going to throw a number out here. So let's say they reallocate $150,000. Now that number could be much, much lower or much, much higher. But they reallocate $150,000 one shot, that's it. And what does that get them? It gets them a death benefit, second to die, tax-free if they never need care, of $186,000 roughly. And in that case, if they need care, we're throwing on an accelerator here using 3% in this example. 3% of the death benefit would allow for them, if they needed care, per person to use about $5,500 per month. And now the what if scenarios occur, right? Well, who knows? What if they never need care? You've got your death benefit. What if they need a little bit of care? I don't know, maybe only $100,000 of the death benefit? Then they have the remaining death benefit paid upon the second death. Well, what if they need a lot of care? And if they need a lot of care and they use up their tax-free death benefit, that's where the benefit of this rider comes in. And so in this scenario, of the $150,000 paid up day one, using $54,000 gets them unlimited long-term care at $5,500 per month per person forever and ever. Amen. It never ends, no matter what type of care they need that is qualified long-term care and for how long. It never ends. All right, so in that scenario, this is how the industry was built. And we still sell, I would say, a fair amount of this. But what's happened is, whether it's the carriers that have become more creative, they have decided that there's different ways that we can design this. So think of it almost like looking at a wall and there's 6 or 7 different levers that you can pull, right? Well, those different levers are different ways that we can customize funding a contract. So let's go to the next example. Now, if you notice, we're still using single premium here. And we're using single premium to fund just the life insurance. And then what we're doing, which we're unique, we're the only carrier that does this right now, we're then allowing for this great and wonderful unlimited benefit on the rider to be paid for even down to a monthly premium. And when you focus on that for a moment, I can't spotlight it any closer with my little gadget here in my hand, but the word that should stand out is guaranteed. And think about that number. Now we have a couple age 61 and 60, total $325 per month in my example. That's it. Is guaranteed to never increase. The premiums will never, ever increase. That is something that easily people can build into their retirement income needs without breaking the bank, especially if they know it will never increase. So think about this scenario. That's another way that you can design our contracts to fit within the needs of your client. I'd like to say one thing before I move off of single premium in these case studies, and that is, I'll flip back to the prior slide. Now this is that single premium packaged for a moment. And let's just assume, now my parents are much older than this, but let's just assume that my parents were this 61 and 60-year-old female. I can tell you right now, if it were my parents, I would highly recommend that they not choose this scenario with packaged, that they choose this scenario on the screen right now. Because one, it's a lot less that's going into the single premium. And as long as it's not going to change their lifestyle, they can easily afford the $300 per month to get that unlimited coverage on the rider. So I hope that makes sense. So moving past single premium for just a moment, I apologize. I'm going to still do single premium, but I'm going to talk about a very conservative client. And this is okay. When I say conservative, it just means that they want to have all options on the table. In particular, what they're saying is, if I change my mind down the road and I want my money back, can I get it all back? And the answer is certainly. We have a product design. It's called single premium with return of premium. And we're going to jack this up just a little bit here with premium and throw in $200,000. And we're going to switch it up to a single person policy, age 70 male. And I'm only doing that because I want to just give you different scenarios. But in that case, if this male age 70 with $200,000 going in, a $250,000 death benefit, and in this scenario, we're going to limit it to 100 months for long-term care in total, 50 on the rider and 50 on the base contract. If he woke up any day, tomorrow, 5 years from now, 10 years from now, and so on, and wanted his money back, he gets the $200,000 back at any time. That is a very straightforward policy design that we have available if someone is considering doing this, but yet they're very conservative and want a return of premium feature. All right, moving on. Now this type of approach, which is just simply recurring premium, and I'm going to show you a pay to 95, not a limited pay in this example today, but this is the approach that many clients are now choosing, even if they could write a check for the 100 or 200 or however much they want in a single premium. They're looking towards this solution because of that one word, and I'll try to highlight it here, starts with a G, guarantees. Meaning that using this example, slightly younger couple, right, 53 and 51, and if you're noticing, that falls into the demographic of people that are traditionally looking at, standalone individual long-term care insurance. But in my example, $5,800 per year creates that death benefit and also allows for unlimited benefits that goes on forever. And back to the G word, that means that the premium will never increase. Now, I'm not here today to disparage or steamroll over traditional long-term care insurance. I still think it's a great, great option, albeit the starting premiums would certainly be lower than what I'm going to show you today in this example if you were to go to any carrier. But what we have as that hanging chad or that outstanding question mark is, will there be, because it's not guaranteed, will there be a rate increase in the future? And what most clients are doing today is saying, I want to take that potential question mark off the table. I'd rather pay a little more for something that's guaranteed, and if I never need care, handles that major concern in my mind because they have an inherent tax-free death benefit to their beneficiaries. Okay, so that's the next way we can do it. Now, if we move on, I'm going to change this up just a little bit. I'm going to use the exact same example, recurring premium. But then I'm going to throw on something new that we launched this year, and you'll see it in the acronym at the top here, SPDR. We affectionately refer to that as the Spider Rider. But the Spider Rider is a single premium drop-in rider. Single premium drop-in rider. Now, what we have to do is we have to design a recurring premium policy first. And then if you go on a bit of a scavenger hunt with your client and some of those lazy or idle type of accounts, whether it's a CD that's coming due in a couple of months, or maybe they are extremely heavy in a cash position in a money market or something along those lines, or even a 1035 exchange in an old life policy, you can drop in, and I'll use a number of $50,000. Same couple, same exact couple. We found $50,000, maybe that's CD, and we want to drop that in. When you drop it in on top of the recurring premium plan, here's what happens. The death benefit increases, so went from $166,000 to $248 in my example. But because you have a higher death benefit, the acceleration rate stays the same, but the monthly benefit then increases. And because we're tacking on this wonderful rider over here in the form of the COB rider, continuation of benefits rider, forever and ever, amen, unlimited, that $74.48 per month per person goes on forever. So that's a way to mix and mingle recurring premium as well as a single premium onto one policy number and not having 4 or 5 different contracts out there. So hopefully that's making sense to everyone so far. We're going to continue down the path of giving you different case studies. Now this one, admittedly, this one gets all of the attention, and it should. You know why? There are trillions upon trillions of dollars of qualified premium, or money, I should say, in accounts today. And many people do that through their working years, as we all know, because they think they're doing the right thing. Max out my 401k or IRA, and then I wake up when I'm, ready to retire, and 80 or 90% of my investments are in a qualified account. There's nothing wrong with that, but there's basically a tax bomb that everyone is facing because you pay ordinary income tax on that. And then especially if you needed those dollars to pay for care, not for insurance, but for care, now you're taxed as ordinary income. And that is a double whammy. So what we can do is we can tackle those same qualified accounts and reallocate them, leverage them into a long-term care plan. And here's how we do that at OneAmerica. So if you look at, I'm just going to say the funding option, doesn't matter if it's a 401k, 403b, existing IRA, we are going to transfer over or roll over, depending on the situation. I'm going to use $150,000. And we're going to go back to that 61 and 60-year-old couple. So $150,000. OneAmerica says, thank you for that. We're day one, and if you're taking notes, please write this one down. Day one, we're going to give a 20% bonus on that. So the income base went from $150,000 to $180,000. Now, what's the catch? There's no catch. We're in essence just front loading the interest on the contract, because here's where the strategy begins. We turn on an income rider day one, and that pays out over 10 years. So we're simply going to take the $180,000, divide it by 10 equally, $18,000. The $18,000 in my example, using qualified money, will be a taxable event. $18,000 every year in a 1099 that they receive in the mail. So what we're doing is we're spreading out the taxes on that qualified account. Instead of it being in 1 year, if they needed it for care, we're spreading it out over 10 years. And we're using that to then fund life insurance and this rider I keep talking about. So here's the numbers on what that looks like. So we're going to use a portion of that for the death benefit, and then a portion of that to pay for the rider. A couple of additional items that have happened with this new asset care that we launched this year that benefit the client are this. Well, what if the client needs care in the first 10 years? In that scenario, if they do need care, we automatically have waiver of premium. And that means that this $18,000 in my example gets redirected to the client. It gets redirected to the client instead of paying for the insurance policies. And then also, when and if they ever need long-term care, we only take the money out of the life insurance, which is tax-free. And then, of course, this rider is also tax-free. So the best way to summarize that is, even using qualified money, if the client needs long-term care services, our policies will pay out at claim time completely tax-free. Now you may say, well, wait, what if the client dies in the first 10 years? And in this scenario, both of them would have to die because it's the second to die. But let's say there's a tragic accident. Both of these clients die. And I'll use year 5. Well, if there's money left in the annuity, which there will be, they'll get what's left in the qualified annuity and the tax-free life insurance death benefit. So in my opinion, I know I'm biased because I represent the company, but this new version of asset care using qualified money really benefits the client in every single way. And I'll finish by saying this. There's not a client on earth that's going to put their money into any of the products that I'm talking about today because they're going to get the best death benefit under the sun, or because if they went shopping, they, are getting the best interest crediting rate on the annuity. Absolutely not. We are vanilla at best in those categories. But where we shine is for one thing and one thing only, and that is long-term care needs. So we like to say around here, keep the main thing the main thing. If the main focus of your client reallocating dollars into these policies is long-term care, that's where they're going to win. If their main focus is, I've got to have the best death benefit, shop for standalone life insurance. Or if they've got to have the best interest crediting rate on the annuity or strategy there, have a standalone annuity. These products are not for those clients. All right, so those are the life products that we have. And I know we're coming up here on only a 10 or 15 minutes left, so this is going to go even faster. Now let's switch over to the annuity marketplace. And this is very straightforward, common sense stuff, but why do people buy annuities? Generally non-qualified annuities, right? Well, they want that growth, they want the deferral, they want the guaranteed lifetime income, and there's many variations of that. But they also want to have it for that catastrophic need, right? Ding, 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 long-term care. So what you're going to find is a number of clients that may have said no to long-term care planning or insurance for years because now they're older. They're perfect clients for this marketplace, or because they're facing into a health issue where you think that you can't get them underwritten with other products like on the life side where there's a death benefit and more underwriting. And then, of course, because this is a very lazy account in an existing non-qualified annuity. So here's the situation. And I'm going to use a very common scenario. You're talking to a client. Generally, they're going to be a little bit older. So let's say that we have Mary, and she's in her 70s, I'll say 74. And years ago, 10, 15, 20 years ago, whenever, she bought a great annuity. Even an annuity that could have a minimum 3% guarantee on it. We see that all the time that are being put into these contracts. But then when you start talking to her about, hey, what if you needed this type of care? How are you going to pay for it? And she says, stop right there. I've got that covered. I've got that annuity. I told you I've got that annuity. And it's done really well. I don't need it for income. It's just sitting there. Well, what she fails to remember in most cases is that if that thing especially has performed very well, and what I mean by performing well is there's a lot of gain on that. So we've got the cost basis, what she funded it with after tax, and then we've got the gain. What she fails to remember most of the time is that when she takes money out of that, if she needs to pay for her care, it's taxed as ordinary income, meaning LIFO, last in, first out. And then if you get to the cost basis, then it's tax-free. So if she has a $200,000 annuity over here, does she really have $200,000 for her care? You know the answer. The answer is no. Well, how can we help with that? Well, how we can help is via existing law under the PPA, Pension Protection Act. That was effective January 1st, 2010. So yes, we could have been using that for almost 10 years now. That law was several thousand pages, but a portion of the law allows for you and for me to put our clients in an annuity that is approved by the Pension Protection Act. So it's PPA compliant. And that what that means is that, like we have in annuity care, if she 1035 exchanges her existing annuity over into our product, and then she needs care, what comes out first is the cost basis. That wasn't taxable at all. But if she needs enough care and uses the gain in the contract, it's 100% tax-free. That's why we say this nice little tagline, tax deferred to tax-free for long-term care. And so you may say, great, Brad, that was a nice little explanation, but oh, well, what's the big deal? So this 1035ing into one of our products, annuity care, is nothing more than a tax play. We're using existing law to get there. And we are compliant with the rules under the Pension Protection Act with our products. But think about this. This is almost like the golden ticket to the pot of gold. And that means now they have access, if they chose it when they bought the policy, to this COB rider I keep talking about. And that COB rider can, and I'm using it just a simple example, that could turn into all the way up to unlimited. So let me show you a couple of case studies. So the case studies will start with, and I'm definitely going to show higher age clients because I want you to see the opportunity here. We can insure people on these annuity products up to age 85 and still get up to unlimited leverage. So this young lady, age 81, she has a $125,000 annuity. She wants to do a 1035 exchange. Now, what's important to her is she wants to have unlimited lifetime benefits for long-term care. So as a part of the exchange, $22,500 pays for the lifetime benefits. I know what you're saying. It's not cheap at all. And then she has in her annuity now, in the annuity value, she has $102,500. And that's great, right? Well, what it provides is $3,000 per month or $36,000 per year, tax-free benefit for long-term care if she uses it for that. But think about it this way in terms of where would she be able to put those dollars in order to generate $36,000 per year if it were just income? Well, we all know the answer. There's nowhere that she could do that because you'd have to earn 29% equivalent in order to generate that every single year forever and ever and ever. We can do that within our products. So that's the first example using a product called just straight up annuity care. Now, the next example is for the client that says, Brad, I love what you're saying here, but you know what? I don't need the unlimited benefits. I just want some leverage, but you know what's important to me? I don't want to pay another dime for the additional leverage out of my pocket. We can do that. So here's how this works on this product called Annuity Care 2. I'm going to lower the age slightly, age 70 in this example. We're going to use $100,000, and that divisor method allows for a little over $4,000 per month if she needed care, tax-free here. And I'm just going to pick, now we have different options for the rider. We could either do what we call 2.5 times leverage, which means 100 of the 250,000 is hers, 150 is the rider. We could do 4 times leverage, so 100 plus 300, so that's 4 times leverage, and then 5.5. Now I'm just going to pick the middle for just a moment and say 4 times leverage. Her 100 turns into 400,000 if she ever needs care. It actually could be more than that if she adds an inflation protection rider to it. But the benefit to the client is this. She doesn't pay a dime, meaning like out of her checkbook or out of the exchange for the rider. What pays for it is what we do is we take off of the interest crediting rate on the base annuity to pay for the additional leverage. This is a very popular offering that we have. And so we could go into a lot more detail there, but what you should always remember, any of these annuity care products, when it comes to funding with non-qualified dollars, every penny that comes out is tax-free. And the last one that I'll show you, now I do, in full disclosure, want to make sure that I tell you that there are some broker-dealers that don't allow you to use a fixed indexed chassis, but we're the only carrier today that has a fixed indexed annuity for the purpose of long-term care. We call that indexed annuity care. And so same premise. Now I'm going to crank up that age again to age 81. We're going to use a slightly higher premium of $250,000, and back to, it's very important to this young lady to have lifetime unlimited benefits for long-term care. So in her annuity is $170,000. $79,000 pays for the rider, right? That's the straight up long-term care benefit. But back to my statement before, where could she take her $250,000, turn it into $85,000 per year using the $7,000 per month benefit for long-term care? Where could she do that and earn 34% guaranteed crediting rate? We just know it's not possible. We certainly can do that because of the pooling of insurance. So with that, I'll finish the annuities with a couple of oh by the ways. The first one is, and I promise you, you will run into this scenario. And the scenario occurs where someone, whether it's a second marriage or whether, they just weren't thinking rationally when they first, bought their annuity years ago, where they have a single owner annuitant in a situation where there's a couple, and they want to use those dollars to also protect their spouse for long-term care. We can do that. We call that eligible person. We're going to follow 1035 exchange like for like rules. We have to, but then we simply on the application designate the spouse as the eligible person, eligible meaning for the long-term care benefits tax-free under the Pension Protection Act, as I mentioned before. Now that eligible person also is required to be the primary beneficiary. They cannot make financial decisions on the contract. But for the purpose that they put their money into this, which is what? Long-term care, they get all of the benefits and back to that tax-free scenario. The last one is, and you may run into this, where you say, hey, the client has a lot of times it's a very, very big annuity somewhere, but yet the other carrier will not play nice in the sandbox. They won't allow for a partial exchange or to split that out. What you can do is think of it almost like a parking lot. So we call this a transfer annuity here at OneAmerica. You could transfer over the entire large annuity that's sitting over there, and there's no taxable event to the client. And then what you can do is split it out using a portion of it for our annuity care contracts, and then the remainder amount, whether you find a new home for it that you think has a better interest crediting rate or a different strategy that works well for their portfolio, you can then transfer right back out within a 30-day period. You can transfer that right back out to the other carrier. So that is important because you don't want to miss opportunities where the other carrier, you say, I can't do that because the other carrier won't allow for a partial exchange. We can do that. So let's finish with underwriting, and we're right close to the top of the hour. And I want to finish with not a ton on underwriting, but I want you to look at the screen for a moment. And on the screen, you're going to see a number of conditions. And believe it or not, those conditions may be insurable here at OneAmerica. We're not an impaired risk company. We're not a substandard company per se. What we allow for, though, is a broader spectrum of approvals. So as an example, on the life product, Asset Care, we have up to 8 table ratings. And why that becomes pretty important is that especially when you're working with couples, and you may have it's almost every scenario, one that's much healthier than the other. And especially with a joint contract, if you can get, the unhealthy spouse at least underwritten, even if it's a table 8, and then you've got the healthy spouse all on one contract, you're going to find that that's going to be a much better offering than what you would get with other carriers where you have single life offerings and you're going to run into probably a decline on the unhealthy person. Because most carriers, whether they tell you or not, stop at table 4. We go clear up to table 8. And then to finish on the underwriting for the annuity care products, that is always going to be simplified and always going to be express underwriting, because we never order APSs on the annuity care products. We never order parameds or labs. The most underwriting that can happen is a phone interview. And that is only if the client decides to purchase that additional rider, that COB rider. So with that said, I've talked a lot and probably ready for a nice glass of water here after I'm finished, but I want to allow Allie to open up the lines or, ask the questions on your behalf if there are any in queue. But while she's doing that and sifting through, I'd like to also finish with a couple of shameless plugs. The first one is really how I began, and that's just simply thank you. Thank you for your time. You spent an hour today listening to this, if you listen to it in its entirety, that you weren't working with clients or helping clients. So thank you for that time. Thank you for the business, of course. And then finally, OneAmerica is trying to put their money where their mouth is. And what I mean by that is we are partnering. Just last year, we started partnering with some very important organizations. And the one that we have started now corporately to be partnering with in the form of sponsorships and donations and events is the Alzheimer's Association. And for those of you that have gone through, like my family, someone needing care due to a cognitive impairment or dementia like Alzheimer's, it is something that is indescribable. And a carrier partnering with an organization like that is imperative, because I'll leave you with one parting piece of data. Most carriers in this business, if they give you the real truth, 40% of the dollars that go out the back door in the form of paying claims are because of cognitive impairments, just like the Alzheimer's Association. So thank you for bearing with me on giving that plug, but we are very, very proud of that partnership with the Alzheimer's Association. So Allie, with that, I'll turn it back over to you if there's any questions in queue that I can answer here in the short term. If not, we'll follow up with everyone after the call today.
Yeah, we do have a couple of little questions so people can stay on if they want or fall off. But the first question was, if you fund with, I think this is just clarification, if you fund with qualified money, is the benefit still tax-free, was the first question.
Absolutely. So in this, and for any of you that are listening that are used to our products over the years, we went through an enhancement this year, meaning a refiling of the products. And what came along with that were some improvements. And in particular, the improvements on using qualified money. Now, this is outside of the state of California. California is still on the old product. But in any other state with this new Asset Care, we call it Asset Care Annuity Funding Whole Life. That's the qualified money solution. When a client needs care, so when there's a claim filed for long-term care, whether it's day 1 or year 22, every penny that comes out is tax-free, because we're taking it out of the life insurance, which we know the life insurance death benefit is a tax-free benefit anyway. And then our COB rider is always tax-free, when used for long-term care? So great question.
I think that you did touch on the qualified funded asset care you said is not available in California, correct?
So we can certainly sell in California using qualified money. It is on an old, I should say, it's been around for a number of years, but it's on an old policy design. So we can still use qualified money, but there are some differences in the policy, and I am more than happy to review those with anyone that has clients in California and you want to see that. There are some changes in how we designed it. It went from our new product is a 10-year strategy. The California one is a 20-year strategy, and you don't get all of those same tax benefits for long-term care, but I can explain that in more detail for those that need it.
Okay, great. What I'll do after the call is I'll connect you and Perry on email so that you guys can talk.
Sure.
He or she. I don't know if Perry's girl or male or female. I've not met you, but for future discussion, so you guys can chat and have some clarity on what that looks like. So I'll connect you after the call.
Sure.
And other than that, I think we're good. Oh, Perry, hi. He says male. Thank you. Well, thank you, everybody. Brad, thank you so much for this. We love having you, and you're such a great partner, so we appreciate you very much.
Well, thank you, everyone. I hope everyone has a wonderful day.
All right, have a good one. Bye-bye.
Bye-bye.